future. We're talking real money.
I'm out of here. I'm out of here. I'm at FRA. I'm full retirement age. I'm leaving. I'm heading out the door. I'm such a liar. I'm such a liar. Hi, I'm Don, your designated liar for this hour of the show, along with Tom Cock, who will fill in for me when needed as a liar. You can do it, can't you?
That's next Saturday for those of you playing along from home. I'll be doing the show on my own, as Don will be going to a voice convention. Now, can you think of very many people that need to go to a voice convention? Don would not be among the people on the list, but anyway, good luck with that.
Where people get old, be here. They talk about retirement. Do you mean that voice?
It's quite a topic.
That's what we're going to talk about today. We're going to talk about retirement because the reason I wanted to talk about retirement, well, one, hopefully most of us are going to do it. We'll live long enough to do it. Two, it's in the news with France. It is. It's in the news. And three, because my wife and I were sitting on the porch watching the golfers across the street. The golfers who, by the way, our house is at a 90-degree angle to the tee, and behind a 3-story home with a big peaked roof. And every now and again, someone still puts a ball through our window. How do you do it at a 90-degree angle to the tee? And I'm
proud to say it's not me because I've never played that course. If it was, you could blame me. But in this case, no.
But no, the question was, though, because I'm going, we were talking about retirement and what people, she has a friend who does the same stuff, tells the same stories all the time. And I said, why does she always tell the same stories? She goes, because she has no life in retirement. She has no new stories because she doesn't do anything. And I said, oh my gosh, that would be miserable. So we got to talking about retirement. And we thought, what a great topic for the show. So we'd like you to call us to join the conversation about retirement. We're going to talk about it a little bit.
Try to call us.
Try to call us at 855-935-TALK.
The phone number's been retired, apparently. Sorry.
He
855-935-8255. I can't help myself.
855-935-8255.
Yeah.
No, why do you want to retire? Why do you want to retire?
Because here's why I want to retire. You want to know why?
Do you want to retire? Okay, go ahead. Tell me why.
No, I don't. I'm liar number two.
Okay, liar number two.
The lead article, lead point in this article is Monday is line dancing, Tuesday is scrapbooking, and Wednesday is caring for grandchildren. Now, they didn't mention, was it Thursday, Friday, Saturday, or Sunday, which are also days of the week that may need to be filled.
It's only a 3-day, it's France. It's a 3-day work week. It's a 3-day retirement work week.
Oh, and I heard that one this morning, and I thought, you could go ahead and say that, but don't look around too closely here because the people are not driving to work on, let me think, Mondays or Fridays anymore in the Seattle area. That kind of leaves Wednesday, Thursday, Tuesday, Wednesday. Yeah, anyway, so, I think this is a great topic. And what are you entitled to when you retire? What should you be? In France, the argument is, as you know, the president, who's already done this apparently on his own, although he may get voted out, I don't know, the vote of confidence thing is coming up next week. But they give you 75% of your pre-retirement income at age 62.
Wait a minute. No matter what it was?
That's it.
I'll take that retirement.
Yeah, I'll take that right now.
Right now.
I love you, Don, but
okay, I'm leaving. Give me 75% of what I'm making now when I finally, for the first time in my life, started making decent money. Yeah.
And here's the problem with that. That ends up being about 15% of the gross domestic product. That's everything produced by France versus the United States.
Yeah.
Where it's 7.5%. Versus Germany, where it's 10.5%.
Wait, it's 7.5% in the U.S. when we talk about Social Security destroying the economy?
Yeah, exactly. So twice as much. And here's the other point that we've talked about. In the olden days, like 25 years ago.
You mean way back in the olden days?
Way back when. You had 4 French people were supporting one person in retirement.
4 French people and a partridge.
And 1 retiree.
In a tree.
Doing scrapbooking. So 4 was 1. Yeah. Today, 1.7.
1.7 supports 1?
Yeah, get the picture. I mean, this whole thing is turning around.
So the worker
those
bees,
demographics are working the same here, by the way.
The worker bees are working a very large portion of their life to support some old person they don't even know.
Exactly. And get back to work is my message to all the young worker bees.
Well, and again, that brings me back to, why do you want to retire? Let's talk about it. 855-935-TALK.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
You know, during the break, I was getting packed to head to France, and then I realized my passport hasn't renewed yet because it takes them like 3 years to renew your passport these days. So I can't go. So I have to stay here. I'm going to stay here for a while, even though France has a much better deal. We did the math during the break, and it's like, whoa, that's a lot more than Social Security's going to pay.
Yeah.
No wonder they want to retire at 62.
Couple polls from France. One poll shows that the French are overwhelmingly opposed to retiring later.
You almost said that. You almost said that in French. Overwhelming.
Overwhelming. But here's the other one that I find fascinating. The other survey they did of people working. 3/4 of French workers have consistently expressed satisfaction with their work repeatedly in surveys over the past 20 years. That said, as many would like to retire as early as possible.
I love my job. I get it now. I didn't know they paid them 75% of their salary.
Okay, if I give you 75% of the salary, you'll leave and I can do the show myself?
Yes.
Okay.
Yes.
I'll get my lawyer on this on Monday.
No, you do that for the rest of my life? I will sign on the bottom dotted line thing right
This will be like the French retirement system. We'll do it until we can't afford it anymore.
Right, exactly.
Then we won't do it. Sorry.
And there will reach a point where they can't afford it anymore.
Yeah, sorry.
855-935-TALK. That number is fully functional right now. It is working. It is all fixed. And you can call really about anything. We're going to talk about retirement on and off, but that's the topic of the hour. But, of course, we take your calls on anything at all.
Topic du jour? Can we say it?
The topic du jour.
I thought you like that. So, yeah, okay.
All right, so give us a call at 855-935-TALK. And John from Cedar Rapids, Iowa. Wow.
Yeah.
The signal carries a long way. Hey.
Exotic.
Hey, John.
Yeah.
Hi, John.
Hey, how are you?
Good. What's up?
Can you guys hear me? Yeah.
Yep.
Well, I listen to you a lot, and currently my wife and I are 61 years old. We have about $1.7 million in different investments, IRAs and 401ks. We don't know when we're going to retire, but my main concern is I do all of the financial stuff, and she doesn't really care to get too involved in it. So I want to have a plan in case, I get hit by a bus tomorrow when I walk out the door. And so I'm looking for, someone that would manage it for us. And so I took your survey and I went to a guy that I know. He works for Carson Wealth Management. I don't know if you guys are familiar with them.
While you're speaking, I'll be looking.
Yeah, that would be great. So So here's how he answered the survey. Do you have time for me to kind of read
Absolutely. This is fascinating.
Prattle on. Yes.
So he's been in the industry for 20 years. He's been at Carson for the last 3 years. I know for a fact where he was before that was Northwestern Mutual, and I know he wanted to get out of that. It's all insurance stuff, and so he wanted to get more into a pure, wealth management kind of a role. He is licensed. He has Series 26, 6, 63, and 7. CFP, CLU, CHFC. I don't know what any of that means. And then under, how does he get compensated? So that first part of your survey under there, it says, it's got the fee only box and all the percentages and that. He didn't check any of that stuff, but he checked under other fees or under fee based. So he checked fee based.
Okay, it's fee based, not fee only.
Okay, let's stop you there for just a moment. This is an important consideration.
Yeah, it's a great distinction.
Yeah, fee only means the client only pays you. That's it. There is no other way for that person to make money. Fee based means in many cases they'll charge you a percentage of the assets they manage and receive commissions on products they sell you. So there is a reason that we regularly say only work with 100% fiduciary, a fee only advisor. That's why.
Okay, what else did he say on there? I'm just curious. This is I can't believe he filled it out. I am really shocked.
Well, yeah. So what he wrote in the box under fee-based was all investments are fee only, but we do a small amount of insurance where we receive a commission. So they do some insurance stuff.
Good for him for being honest about that. That I kudos for being honest.
Which I thought was probably okay. What I didn't like was, he has some fee-only kind of investment stuff, but he didn't put like a percentage on the first amount of money, that kind of stuff. He didn't answer that part. So,
well, the good news is, John, he has to answer that stuff on what is called the Form ADV Part 2 brochure that is required to be filed with the SEC and made available to clients. And would you like to know what his maximum fee is? I can't wait to see Tom's face.
I'd like to hear it, yeah.
All right. His maximum fee is 2.5% of assets.
Oh, my goodness. Really?
I knew
In 2023?
Yeah,
was it 1985 or something? That is an outrageous charge.
Yeah,
truly. Truly out. That's not even within reason, 2.5%. That's crazy. And I can see why you wouldn't want to put that on paper either.
Yeah.
Yeah. Well, okay. So I can see that I won't be using him. But yeah, so the rest of it, under the kinds of investment philosophies, he's got passive mutual funds, ETFs. He's also checked options, futures, individual stock funds.
Really scary.
This is why, by the way, this is so important. This is so critical to everyone listening. This is why when people say, well, I got a fee-based guy, he's good. You got to get into the details with every person. The devil in this stuff truly is the details, because 2.5%, please don't pay anything more than 1. Number 2, I would not use somebody who's trading options. I would not use somebody individual stocks. For a lot of reasons that we've talked about on this show and on this podcast. Yes, passive exchange traded funds and mutual funds, you betcha. But those are the reasons I wouldn't get near him at all, because the rest of that, the fee and then what he's using, Don, I think is crazy.
Yeah, and the other thing, this is always a giveaway. If you go whenever, and this is for you and everybody else listening, John, when you want to check somebody out, go to this website, and we have this website at talkingrealmoney.com/help. Go to advisor, spelled ER, advisor info, all one word, .SEC, Securities and Exchange Commission, .gov. And then type in the name of the company. And I did that. That's how I got this information. I got it from the Securities and Exchange Commission's website. I can pull them up and look at them really fast because I do it all the time. But one of the big giveaways about a great full 100% fiduciary advisor versus a not so great semi-fiduciary advisor is the length of their ADV Part 2 brochure.
Oh, please. How many pages? Come
His
on.
is 65 pages.
No, that's ridiculous again.
We work with a very large firm that has a 37-page ADV
Which
Part 2
I don't
brochure.
think you need it even that big.
Even that's a little long because they're extra careful. But no, this is one I would absolutely positively skip. The maximum fee that anyone should charge, right at 1%, maybe 1.1 maximum, and it should have breakpoints where it goes down from there.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Isn't this interesting? 855-935-TALK is our phone number, 855-935-8255. Give us a call. Lines definitely open, but the phones definitely work. I also went to the form ADV. The SEC is not really good at naming things.
Like ADV?
We have a form ADV, and then we have a form ADV Part 2 brochure.
The brochure, yes.
Yeah, which is very confusing.
We have the abbreviated one. What's
Yeah. I don't know. I just don't care anymore. But Carson Wealth Management is kind of interesting. I went to their ADV, and listen to this: other businesses, other business names for the company.
Yeah,
Wealth Management Inc., Taylor Financial Group, Barrington Wealth Management, DSF Wealth Management.
Well, they probably
Equity
just bought
Planning,
up other firms.
Granite Wealth, Pesta and Pesta. I'm going down the list, and it's like, holy mackerel. Schlipman, Carson International Alliance, Carson Financial, Graves. I was trying to get to how much they have under management, but there's like 400 pages of other. I'm still not done. I'm scrolling as fast as I can. I've gone through like 50 pages of their ADV, and it's all other names of their firm.
Yeah, they just bought up other firms, and they probably retained those names.
Oh, I can't believe it. I can't even find their assets under management because it's so buried. All right. Well, I'll find that eventually. They're a big firm, apparently.
Yeah, and but again, the important thing here is people hold themselves out as fiduciaries. They will say, yeah, we believe in that same philosophy, low-cost index diversification, most of the time. Then, as I say, the devil's in the details, because then you're in and the devil goes to work on you, right? I mean, you got to own this, you got to own this, you should try this. We know that this stock's going to work well, and you're at risk. So you need to work with a firm that is a 100% fiduciary that says and lives up to an approach that believes in asset allocation, diversification, low cost, tax efficiency, and doesn't veer into these other areas that, frankly, there's no reason to veer into.
They are big. You probably have heard of them. They have 35,000 clients.
Wow, I'm just trying to decide how many we have, because we have...
Not 35,000.
No,
and they manage...
Might be 5,000, though.
They manage almost 20 million last ADV. 20 billion. 20 billion.
20 billion
last ADV.
Yeah. See, we're just a hair under 4 billion.
Yeah, so they're big.
Yeah.
They're big.
I would not hire them.
Yeah, they're just under 20. No, not with... I mean, the first thing... The immediate kicker is the 2.5%.
There is literally nobody charging 2.5. I mean, yeah, if you walked in the door to Merrill Lynch, I guess, tomorrow and said, hi, I don't know anything about anything. What's their max fee?
They've lowered their fee. Hold on.
All the way down to what, 1.75 or something?
You can find it. You just go to talkingrealmoney.com/help, and that'll take you right there. And then you go down to We Research Financial Advisors, Compare Advisors, just to put things in perspective. Our firm, Appello Wealth, charges 1% on the first million, right?
And half after that.
And 0.5% after that.
Yeah.
Merrill Lynch now is down to a mere 1.80.
I was close. I said 1.75.
Oh. What's really interesting, though, is that Ed Jones came down to 1.44. That's...
So they're moving in the right... Will they move quick enough?
Yeah, Yeah.
Take as no. Okay, but that's the old.
Yeah, and your internet just went out. Just thought I'd tell you. Your internet died completely. It went all robotic, and then it died, which is great because we're coming up on a break, so it gives you time to redial. Comcast is coming out. Just to give you an update on Tom's internet, they came out and they came out and they looked at it and they went, "Oh, somebody wired this wrong. We're gonna have to tear up all the cable and redo it." 855-935-TOM.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hi there. Welcome back to Talking Real Money. Don McDonald here, Tom Cock there. We're hoping that we're helping you enjoy a better financial life.
Hoping that we're helping.
Wow, he turned it into a jingle. That was pretty impressive. I was impressed. 855-935-TALK is our phone number, 855-935-8255. Please give us a call. We'd love to answer questions, solve problems, listen to your concerns, and almost anything, as long as it has something to do with money, is a reasonable topic. You remember
and why? Yeah, go ahead.
Yeah, do you remember on the weekends? Why? On the weekends, there was like these shows about informational shows, and I think it was on NBC, and it would say, "The more you know." Well, actually, our motto is, "The less you know, the better off you'll be when it comes to money." You try to know too much. I know. Isn't that weird? You try to know too much? How can you know too much? Well, because in some cases, apparently, at least money-wise, ignorance is bliss.
Yeah, it's a fascinating thing. And this gets back to what we were just talking to John about hiring a manager who uses mutual funds and exchange-traded funds. When people start picking individual stocks, when they start using options, when they get into more complex strategies that require trading and anticipating and thinking what's going to happen next, we don't trust it. Why don't we trust it? Because our own brains do the really bad things to us when it comes to this. This is not our work. This is fascinating to me.
We don't work that hard.
No,
this is not our work.
It's a fascinating thing. This comes from an article by Spencer Jacob in the Wall Street Journal.
Yeah,
Wall Street Journal.
Yeah, I like Spencer's work.
Yeah, very good. And it gets back to this aspect of, and I think it's kind of an American trait, the harder you work, the more successful you're going to be. Except, as you just pointed out, Don, the exact opposite is true when it comes to your money. So they did, this is fascinating, 1973 survey of 8 talented handicappers to guess the outcome of 40 horse races in 4 rounds. Yeah, I know that's 50 years ago. But here's the part that's fascinating.
But the results are still relevant.
It's very relevant. They asked them they gave them some information. They said, pick the horses. And guess what? They had 17% accuracy. Okay, that sounds good. Then they kept giving them more information. Well, wait a minute. But what
about their level of confidence, though? That's
their
important.
level of, pardon me, I was going to get to that. But okay, their level of confidence was low, right? Because they were sort of guessing blindly about all this.
They didn't have a lot of information. They just had some.
A little bit of information, and their confidence was, I think I'm reading this right, about 19%. They believed that they would be right about 20% of the time.
They were actually right 17% of the time.
Yeah, they were actually right. Then in the next 3 rounds, they said they give them a lot more information. I could get into the details. I think it confuses it a little bit. Lots of bits and pieces of information about the horses, obviously, and maybe the jockeys, etc. So you would think they would do better, right?
Well, their confidence rose, though, as they gained information.
Doubled.
That's the thing, is that the more information they had, the smarter they thought they were, and the better they thought their chances were of picking the right horses. And yet the punchline is, Tom, how many pick the right horse with all that information and all that confidence?
17%. Wasn't it 19 earlier and 17?
No, it was 17. It was exactly
17.
the same.
17 accurate. You're right, correct. But they thought they were going to be at 19. So they thought that they were going to be far better than the results they actually produced. This is why, when it comes to your money, that truly, you're right, Don, just kind of putting money, spread it around, keep your costs low, not paying attention too much. By the way, if you want to be in the stock picking arena, I find this fascinating. Most people that are picking stocks, out of 10,821 analyst rankings on stocks last April, only 6% were sells. So basically everybody's saying you got to own blank, right? That's fascinating to me.
You gotta own blank.
And a lot of people follow the bigger companies. They say there's some like 30 analysts and forecasters around. Apple, the big companies, have millions and millions of dollars that are following those firms. So when you come to us and tell us, well, I'm going to stick with fill in the blank because I know it's a great stock, I'm going to say, why do you believe you know something that all the people that study this don't believe?
And one of the things I really found fascinating about this story by Spencer Jacobs was his reference to Goldman Sachs and an 11-page report they wrote. I love this. Now, Goldman Sachs has lots of information. In October 2001, they said in an 11-page report that Enron is still the best of the best. 3 weeks later, they filed for bankruptcy. This is after all that research. You just can't know what you can't know.
Tom and Don are talking real money.
Do me a favor. Grab your latest investment statements if you know where they are. How many do you have? A lot? How many different investments are in each statement? A bunch? Do you own individual stocks, bonds, sector funds, and stuff you don't understand? Yeah, I thought so. I'm Don McDonald, and I'm pretty sure you have a case of hodgepodgeitis. But don't worry, it's not terminal and can be cured. But it takes three things: a bit of time, some fiduciary guidance, and a plan. There's a problem, though. Most financial advisors can't or won't provide any of those. That's where we come in. Tom and I will provide you the help you need to overcome hodgepodgeitis in a free, no-obligation meeting with an Appella advisor at TalkingRealMoney.com. So, scan or take a picture of all those pages you gathered, then go to TalkingRealMoney.com, click on Meet an Advisor, and set up a free appointment online or by phone when it's convenient for you. Let us sort through the mess and help you get started on a better, simpler future plan. Just go to TalkingRealMoney.com or call 800-386-3004.
Your guides to a really great financial future. Tom and Don are talking real money.
Want to call us? It's easy. 855-935-TALK is our phone number. If you want to ask questions when we're not here, call that same number. Or go to TalkingRealMoney.com. 855-935-8255 24/7. Sue, welcome to the show, Sue. Hi, Sue.
Hi.
By the seashore?
Hi,
Yeah.
can you hear me?
Yes, ma'am.
Yep.
Hi. Thank you for taking my call. I'm 65 years old. I will be 66 October 25th this year. I'm thinking about retiring, but I'm not sure if I have enough. Kind of scary.
Okay, Sue, what do you do for a living?
I work as an engineer, quality engineer.
Okay.
I make six-figure income, and but I'm thinking about retiring, and
Well, you know, that brings us to the question we asked at the beginning of the hour, and that is, so why do you, I'm just curious, before we get to your assets, why do you want to retire at age 66?
To enjoy my grandkid. Just have a granddaughter.
Oh, okay.
And other,
that's fair.
That's a good reason.
other
Okay.
things.
Now, why are you concerned?
Need to retire?
Yeah.
Okay. My concern is, do I have enough? If I start pulling Social Security in April next year.
Well, let's talk about what you have. What kind of investments do you have from which you can derive an income?
Okay, I have about $505,000 in 401k and HSA and Schwab. Some investment there.
Okay.
And I need per year about $55,000.
Okay, and what is your Social Security benefit at full retirement age?
at 66 and a half. In April next year, it'll be 31,000. And if I pulled my retirement account at 5%, would that be okay for about 13 years until my mortgage is paid off? In 13 years when I'm 79 years old. That's my basic question.
Well, okay, you're asking a lot of questions.
And 4%
one
later.
time. You're asking a lot of questions.
Sorry.
Okay,
Yeah.
but let's start with the easy one about the 5% withdrawal. 5% is aggressive. Yeah. We talk about this here on the show. We talk about it at retirement. Our friend Paul Merriman puts it out there, and I worry sometimes people just circle, I'll just take the 5%. What we're talking about when we say 5%, that is a variable withdrawal strategy. That is not fixed. That doesn't mean it's 25,000 in your case this year, added more for inflation next year, et cetera. That is whatever the market gives you versus a 4% fixed, which would be only $20,000 a year, which we would expect the portfolio to last longer. But here's another question. A lot of that depends on how that portfolio is built, too, because people think, I can just go ahead and do that. How much in stocks?
Well,
how much in bonds? How balanced?
I honestly think we're not even to that point yet because, I mean, even in my simple little non-math brain, if you were to pull 5% out of $500,000 along with your $31,000 Social Security, you are going to have a shortfall in meeting your living expenses right off the bat. You're going to be making $59,000 by my calculation, and or less than 50. I'm sorry, no, you're going to be making $56,000.
25 plus 41,
50,
yeah. So you'd be less
56,000. You're going to be $10,000 short a year.
But if she's saving out of that 65 money into a retirement account, et cetera. Oh, that's right. She already said.
She said that's what she needs to live on. So I'm really concerned. I'm very. I think if you retired at this point next year, that you would be skating right on the edge.
How about the mortgage? My mortgage will be paid off in 13 years. That's about $12,000 a year. So by then, it'll be reduced, right? My expense.
But the problem is, you're going to be about that much short every year until that mortgage is paid off, which means you would have to more aggressively draw down your retirement funds, which means you could, in some scenarios, possibly run out of money before you even get to that point.
And here's something that we don't really suggest unless it's the last possible thing, which could work in this case.
An annuity.
And that is a reverse mortgage.
And an immediate annuity might work in this case, too.
An immediate annuity where you give the money to somebody, they pay you back a set amount every month. It doesn't get much return on it.
It wouldn't get any. You would just get about a 7% check.
Yeah. Of that balance.
Which would get you there, but then you get no growth on your money for the future.
And it's not yours.
And it's not yours
that's the
anymore.
other part. But I would look at the reverse, because the reverse would do two things. The reverse might give you access to some money, and it would stop mortgage payment.
Good point. But
now you just reduced your expenses by that amount.
Though?
I would look at that immediately.
I would look at that I would look at that in the year before you plan to retire. I would have that plan in place.
Yeah.
I would do it soon. I would start the process in the next few months. Because that could actually, Tom has a great point. We don't recommend that or suggest that very often, but that could be a saving grace in this case because it would get rid of your mortgage. You wouldn't, or get rid of your mortgage payment, and you'd be pulling money out of your house right now while you're alive, rather than leaving it to your kids and your estate. And I'm a big believer.
I want to leave it for my kids.
That's
a terrible. Why? Is it emotion? Is it just? They don't. Do they all have good jobs? Do they have good jobs?
Yeah.
Then why? They don't want the house. They're just going to have to sell it. You need to have enough money to live on. Your survival.
It should be about her.
Yeah, it needs to be about you. Your kids are doing.
Okay, I'm concerned about my second one. I guess my second kid. I'm not sure if.
Well, then set up a little trust for him or something. But I think really, truly, Sue, we don't say this very often, but you're just, in the best case scenario, you're just barely there. Worst case scenario,
Barely.
you could be in trouble.
I would immediately look at the reverse mortgage.
Yep.
Definitely. I would immediately look, as Don correctly points out, at an immediate annuity. I think there's a website, I forget the web, but it'll give you the numbers.
Annuity.org or something like that.
Yeah, something where you get, don't just call an insurance company, but I would look online at what you could get and think that through. But I think, again, doing these things now immediately so that you have a plan rather than waking up a few months before you decide to pull the trigger and doing it, because this is a little in your circumstance, a little late to be running those numbers.
Yeah. So, Sue,
Also, something to consider. Also, my expense vary from $43K to $55K.
Honestly,
you said you said 65 earlier.
Yep.
No, I'm 65 years old.
Okay, I thought you said $65,000. If it's only $44,000 or $45,000 a year,
About $43,000.
43 to 50, then you're okay.
Yeah.
In that case, you are okay. And I think we like the 5% flexible withdrawal, but that means in some years you're going to have a little less, in other years you're going to have a little more. Thank you.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And this is for Sue and any of you. And I should have said this to Sue earlier. If you would like to have somebody look this over and just to see where everything is and how it's structured and whether you're in the ballpark, really look at the numbers, look at your actual accounts, because we're just kind of spitballing it here. Just go to talkingrealmoney.com and meet with one of our advisors. Sue and anybody else, I promise you, you will not get pressured to become a client, to buy anything, to do anything. You're just going to get some help. We found it's really a great way to provide help, and it's good for our business, too. Just go to talkingrealmoney.com and click on Meet an Advisor.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.